AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines.
Bay Area real estate and mortgage experts with over 25 years in the business.
Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us today, all those folks on Facebook, as well as you sitting in your car, hopefully driving safe. You can always reach us at 800-516-1220, 800-516-1220 to get your calls in the air. You can email us, Tony or Gordon, at bayarealoansource.com. Podcast at bayarealoansource.com as well. Radio's not going to last forever. We've been on the air for how long?
Many years.
12 years?
Many years.
12 years now. So the podcasts are growing steadily. So that's always a good thing to know. And you can get those at Facebook, or you can go to our website, bayarealoansource.com. So mortgage rates eked up a little bit again, as suspected, 5.81%. According to Freddie Mac weekly survey, 15-year at 4.92% and the 5-year ARM at 4.41%. We left out the ARM part of this survey for the longest time because it didn't make sense to even say it. In fact, we saw the ARM rate very close to the 30-year fixed rate when it was down at all-time lows. But now we're going to start saying that a lot more often, Gordon. We're seeing ARM usage in some cases skyrocket. The Mortgage Bankers Association, they had this big, huge meeting in New York, and some of their representatives there were talking about the purchase applications that they were coming through. I think they surveyed about 3,300 applications, and over 50% of them were ARM products.
Well, that's interesting because we priced out many ARMs this week, and the difference, the margins between the two is not worth mentioning. To opt out for an ARM versus a 30-year fix, the margins are tight. You might as well opt for the 30-year fix. So I'm interested.
Well, some of those were on the non-QM products, though. We're talking about just the Fannie Mae and Freddie Mac products.
No, those were QM products that we were pricing out. Those were actually QM. We were looking at bank statement programs, but we're also pricing out on the service. Those are actual QM products.
But it's still. When anyone could get this, you can go right online and get the survey, Freddie Mac PMMS, Primary Mortgage Market Survey, and you can see that's 1.4% difference in rate, 4.41. Now, a lot of people are like, 4.41, it's compared to what it is today. Historically, the rates are 6.25. 4.41%, yes, we were down to the threes, but that's still a great rate. But yeah, you have to have it for 5 years. Is that long enough for you? Is that long enough to ride out the higher interest rates? We don't know that answer yet. But we do know that you can save some money right now. And because of the increase in the 30-year fix, we're going to see a lot more people, as we've predicted at the beginning of this kind of cycle, that more and more people are going to go towards ARMs.
Yeah, typically the problem with the 5-year ARM, of course, is the qualifying. The qualifying rate is actually higher typically than the 30-year fix. That's a lot of times people don't actually opt for the 5-year ARM. To get I think the break even is a 7-1 ARM in which you actually qualify at start rate. So what I mean is if you to go back to the scenario you just offered at 4.41, if I want to qualify a borrower for the 5-1 ARM, I'd have to qualify with a higher rate. And as we know, as rates go up, reason why a lot of people are opting for ARM is because they're not qualifying. So that's kind of throw the wrench in that formula. So the market's doing a lot of different things. The market is actually slowing down. I listened to a report today. The Feds have been very aggressive in increasing rates, trying to slow the market down. But at some point in time, it's like tightening the screw. You gotta wait for a period of time. You just can't keep tight. You have to wait for the tightening to affect the marketplace. I know we want to get control of inflation, but you really have to wait to let the market catch up to itself before we start automatically increasing rates on top of rates on top of rates, because it can lead to devastating effect 6 months down the line because we tighten too fast too soon. So Fed, hopefully they're listening to me, and hopefully someone's listening to me. Somebody's listening to me, but hopefully they are listening to me. But sometimes when I listen to the experts on all these different topics, I always wonder how do they get qualified to be experts, because their information is no better than mine.
One of the MBA, that's the Mortgage Bankers Association panel members, Tomiak, said adjustable rate mortgage is their trading volume soared in May, with nearly half of the loans locked through the exchange were coming in the form of an ARM. He continues to say this trend is only expected to continue through June as buyers are adding ARM programs and are pricing offered sellers an opportunity to take advantage of the growing market. So we are seeing it's not just the buyers that are doing this. It's, hey, I want to get a mortgage. Oh, I can't, I don't like that payment. Oh, why don't you try the ARM? So it's the industry is telling itself to start selling ARMs. So what do you need to know about an ARM? You briefly mentioned, the qualifying. I believe the 7-year you could qualify at the note rate or the margin, the fully indexed rate, the margin plus the index, and then the 10-year at the note. Same thing with the 7. But what are the other things you need to know about an ARM?
Well, first thing I'd like for you to start by calling it by its rightful name, not the ARM. It's a fixed rate ARM. There's a difference between an ARM and a fixed rate ARM. So I'd like for you to start there.
There's a difference. Yes, you're right. Okay, so there's a difference between a true ARM, and that's where it adjusts every month, and then a fixed rate ARM. And that's where it's like a 5-year fixed. It's going to be fixed for the first 5 years, and then the rest of the 25 years is going to be adjustable on a yearly or 6-month basis. The most popular loan right now is the 7/6. That means it's a 7-year ARM. It adjusts every 6 months to whatever index it's tied to. The margin never changes. It's negotiated and upfront, and you'll know what that is pretty easily by looking at your note. But
so in layman's terms, the payment on that product you just mentioned, you'd have 84 payments at a fixed rate cost.
Correct.
And then after the 84th payment, on your 85th payment, you have an adjustment, and that adjustment would activate itself every 6 months, so the people actually know what they're actually getting into.
And where people get kind of fearful of ARMs is when that 85th payment comes up, in this case on a 7-year ARM, is what they call the first adjustment. And the first adjustment has caps on it, but those caps have increased, I believe, up to 5%. Your first cap can go up 5%, and then each adjustment after that, it can go up 2%, and then max is 5%. So if you do see interest rates increase that much, your first adjustment could be significant. Now, the general rule of thumb is that when rates are higher, you get the ARMs. When the rates are lower, you get the 30-year fixed. So where do you think we are in the cycle? Would you feel more comfortable getting an ARM now, knowing that you don't think that you're going to see rates go up 2 or 3 or 4%, or that index, that is, so that ARM will adjust much higher, and you're like, oh, I should have got the 30-year fixed?
Well, as the market changes, there's many different strategies you have to look at. For example, we were talking to a client today about a fixed rate ARM versus an interest-only payment. Since the rates are so high, inevitably, the borrower or client is going to refinance that product probably for the first year, 2 years, or 3 years, because typically on these loans, there's no prepayment penalty. So knowing that nomenclature piece of information, typically the ARM is the best product. Why opt out for a 30-year fix if you have no intention of staying in a 30-year fix? We talked on the show many times, the average person stays in a 30-year fix about 5.5, let's say 6 years. So why spend the extra higher interest on a 30-year fix, knowing darn well you don't plan on buying and staying in a 30-year fixed loan? So those are all the things that we look at. Those are all the features or benefits of these programs that we try to spell out. And once the person understands the feature, the benefits program, they can make the best decision.
I'm going to argue a little bit with you, Gordon. I think that you just quoted something that contradicts what you've said in the past. There is no new norm anymore. We're writing our new pages right now. So I don't think you can say that people that got a 3% interest rate are going to refinance every 5 or 6 years, or 6 or 7
Well,
years.
I'm gonna argue that I'm absolutely right, because rates go up and go down historically. So we know rates are high now. We know for sure that rates are going to come back down.
No, we know that, but we
So,
don't know that
conversely,
people that have that rate. There's people that I talk to on a daily basis that say, my rate is more valuable than my house because I borrowed that money so cheap. That's why my house was worth as much as it was. Right. So that's why I was able to pay for it. So I'm not willing to give up my rate. And as rates stay where they are now, of course, we have a different perspective. Rates are higher, but we don't have short-term.
But that argument is only valid if you have a 2.5 or
Ask me in a year.
rate that's
Ask
3%.
me in 2 years.
For sure, we know in 2 years rates are going to come down. conceivably will, because in 2 years we'll be looking at election.
Okay,
Things have
so
to happen election year. The market works great. The market, I always say, the market works on cycles. It works on movement. We were stagnant in a low direction for too long. Now as rates go up, people are mannequin, and now of course another 2 years we'll have another refinance boom. That's just how you generate and spook an economy.
My argument is just I think we're going to see those people who got the 30-year fix at the low rates are just going to keep it longer. There and that is going to be part of the new
until there's a need. Once again, you can have a low rate.
I think we're going to see a lot of those people.
You have to go out and channel that energy only asset, which is that house. So what's the sense of banging on? Hey, I got a 2.5% fix, but I got 15% car loans. You have to make sense. You have to. That's where education comes in on how to balance your budget, how to manage your rate, and how to get the best out of it.
Okay, you can. It sounds all good until it actually happens.
Okay, fair enough.
So I actually think we're going to see, just like we are seeing people stay in their houses longer. When I first got in the industry 18 years ago, it was people stay in their house 7 years. That's well over 12 years now. I think we're going to see that the same thing with mortgages. So with that said, keep that in mind when you're looking at an ARM. I know it's hard to predict 5 years, 7 years, 10 years out. A lot of people are going for the 7 and 10 as opposed to the 5. But if let's say you have a timeline, you need some cash out, and you want the cheaper money. Maybe the ARM does make sense because maybe it is something you're going to do to fix up the house and sell it in that 5-year period. So the ARM does have a purpose. But I think that you have to think the way that Gordon is saying is that, and I do have a question for you about where you think rates will be in 2 years, but you have to think that way about where you're going to be, where rates are going to be, and what you think you are going to be in order for this to work for you.
A lot of things. Time, they say, time heals all wounds. Time makes lots of changes. Time makes us look like experts, or it makes us like idiots. It all depends on this decision that you make, and of course, that decision, once time come into play, would prove itself to be either a good decision or a bad decision.
Well, a lot of people were wounded coming out of the Great Recession, and I think we're not going to quite see the ARM usage get up to where we saw it back in the pre-Great Recession in the 70s. 70% of the people buying a house were using an ARM. I don't think we're going to see that, but we're going to see it get pretty high. I want to come back and talk to you. You said that rates will certainly come down in a couple years. Now, certainly I don't like using that word, but if that's the case, why not get an ARM and then know that you can refinance later as rates come down and then get that 30-year fix? Some of the things you can think about. We'll come back after this break. I'm Tony Mendez. That's Gordon Hines here on AM 1220 KDOW. We'll be right back.
Questions about real estate? Call the program, 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines, on this June 23rd. This is the last show of the month of June, Tony. Year's halfway over already.
Oh, my God. That's insane. It was a couple days ago. It was the first day of summer.
Yeah.
My family flew out to New York for several. I'm all alone. I'm a kind of a temporary bachelor at the moment.
Okay, empty nester. It's probably a better term.
Empty nester? No. That's when they go off to college.
Well, you're a temporary empty nester until they come back.
All right. Well, they certainly aren't going to college.
Okay.
With that said, we left the last segment talking about something that to a lot of people it might seem like a very risky move to get into real estate, but especially if you're speculating, it's definitely risky. But if you need a house, what are your thoughts, Gordon, on what rates are going to? You just talked about last segment how, and I don't like using the word certainly going to be lower than they are today. It might be better to say it's a guess. I'd rather guess that it's going to be lower and hope that it's lower, but I'm not going to say for certain. But let's say that rates are going to go lower, which they will. Rates go up and down. We already know that. Let's say in a couple of years they're going to go down, and you buy a house today. You qualify for it. Yeah, you don't really like the payment. You can pinch some stuff here. You might not go and buy a coffee every day for $4 or $5, or you might go to the discount grocery store instead of the one that you go to. But with the anticipation that somewhere down the road, your house value is going to do what it's doing. You're paying off some principal. You have equity. You have a lot of skin in the game, as they call it. You put some good down payment. You got it where you want it, but you want the lower payment down the road. Is that a strategy to say that, my rates are going to go lower and I'll just refinance it down the road? Do you think they're going to come back to where it makes that much sense? Because a lot of people are saying we're never going to see sub 3% ever again, if we're even close to 3%.
Well, whoever is saying that is an idiot. I can tell you that much. Contrary to your belief, I guarantee rates are going to come back down. How low they're going to come back down to, I could not guarantee it, but I know for sure they're going to come back down. Are we going to see rates back to hovering around the high threes, the high twos, low threes? Yes, we will. It's just a matter of time. So because we already know that the blanket of life is sometimes things get covered and they get uncovered. The economy works on stimulation. When the economy gets, the Fed now are tightening up interest rates, trying to slow down the economy. Unemployment now, people are going to start getting laid off from jobs. Chase just announced they laid off another set of employees this week. So as people get laid off, now we need to re-stimulate the market. How do you best way to re-stimulate? By lowering interest rates, get people to spend money again. It's a cycle. It's just go back and look at it. If you go back and chart, you can chart this stuff out. This is nothing we don't need to guess about.
You don't have to argue with me.
Well, no, you just made a statement.
No,
that
I told you that somebody else said
down.
that. You
okay,
didn't hear it.
And I told that person's an idiot. So
you got all personal about it, like somebody's attacking you.
Well, yeah, they're attacking what I'm saying. So.
Well, Powell came out. They said he's strongly committed to bringing down inflation, and they can do it with their monetary policy tools. At the Fed, he said, we understand the hardship of high inflation and what it's causing. We are strongly committed to bringing inflation back down, and we're moving to expeditiously do so. He continues to say we have both the tools we need and the resolve it will take to restore price stability on behalf of the American families and businesses. So I think that we're going to see rates go up before they come down. Is it fair to say that?
Yeah.
How much it goes, we don't.
We know that the Fed's going to do at least another one or two more increases through 2022. So, of course, we can conveniently say that rates are going up before they come back down. I believe that we've got another 18 months of possibly interest rate hikes, maybe not to the tune of 3/4, maybe another quarter, another half to try to slow the economy down. But you got to be really careful in slowing that economy down. It's like slowing your heart down. You slow your heart down to it's going to stop. It won't restart again. So all I'm saying is I think these things are all good, but it's a managed cycle like everything else. Managed care, managed cycle, managed economy. You got to put your finger on the trigger and make sure you manage it right because we're all in this thing together.
I think one of the Fed, I read this, one of the Fed presidents, I can't remember her name, said that we're lucky that we don't have we have high unemployment right now at the same time.
No, we have low unemployment.
No, I know. She said we're lucky we don't have that.
Okay.
Could you imagine if we did, I think was the quote. But yeah, if we do start seeing that, you've always, I've heard you say this multiple times, even to people on the phone, is that, the Fed's putting, they're building this up so that these interest rates. I'm going to correct you on the predictions. We believe it's been said 0.75 will be the next hike, and then 2.5 hikes after that to finish off the year. So we're looking at another. What does that add up to? 1.75 in another by the end of the year. How's that going to translate into the mortgage rates? It depends on what the market does and how they react. We're going to go through, and it depends on if we get into recession. If we start seeing enough of the numbers to show a recession, then I think the markets will react and the rates will go up.
Yeah, well, you've got to factor in. You've already got constraints as far as supply is concerned. Demand is just strong, but we have a lot of issues you still can't get. You go into some stores, especially, I go to the builders, Home Depots and the Lowe's, and a lot of things these stores don't have. So when you have to put that all into a formula, you just can't pencil out you're going to raise rates another 0.75% without taking into effect all the other terms going on in the marketplace. You got a war going on in the Ukraine with the Soviet Union. They're backing back on the supply of oil that they're shipping around the world. All these things affect the global economy. So when you sit back and you plan on what you're going to do, sometimes it's like a basketball game. The team that make the adjustment is the team that's going to win. So whatever they have planned on the slate as far as increases is concerned, just make sure they're relevant to the timing of the marketplace.
Well,
that's all I'm saying.
They've maintained the tone that they will be flexible, and quick on their decisions. So that is a different tone than we had 10, 15 years ago. So we have a Fed that is willing and able to, according to Powell, have the tools and the resolve to move forward with the right policy. Whether or not it's right for you, it's a different story. It seems like a lot of people that have decent jobs and good pay are saying, I want to see interest rates go up. It's hurting a lot of people. We were just talking about interest rates in the first segment. Home buyers on a $2,500 monthly budget on a purchase have lost $118,000 in spending power this year among mortgage rate hikes. So the buyer can afford $399,750 home at today's mortgage, roughly 6%. That's $118,000 less than the $517,000 home that same budget could have bought at the end of last year. So I believe that we're going to be okay as long as we don't hit a large amount of inventory hitting the market. We're still 50% below the amount of inventory that we had pre-pandemic. So we did see that some reports come out and say that inventory is up again, up 17% year over year. That is continually rising from about March. So, and it went positive finally. I think inventory is going to be the key here when it comes to real estate. Put all the other market and economies aside. It's going to come down to real estate.
Well, if
inventory.
Once again, inventory is the key word for supply and demand. The market was very, very busy, very in demand because there was less supply and more demand. So if you add more inventory onto the market, you raise rates, you're going to have less demands and you have more supply. So typically the property value should come down or at least stay stable. One of those three things is going to have to give in, especially if you add unemployment and all those different figures, property values will come down.
Since I have the mic, you're welcome to call the show, 800-516-1220, 800-516-1220, and side with me a little bit, or Gordon. Yeah, you can call Gordon too, 800-516-1220 to get your calls on the air. We'll come back after this break. I'm Tony Mendez. That's Gordon Hines. It's the Real Estate Report on AM 1220 KDOW. We'll be right back.
Phone lines are open on the Real Estate Report, 800-516-1220. That's 800-516-1220.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
Okay, so we've been talking about interest rates, how it's been affecting the average buyer out there. Yes, we are going to see, obviously, interest rates go up, less people qualify. Or you qualify for less, one or the other. You need to make more money to qualify. So a lot of people are saying that, yes, home prices are going to be affected by this. I believe that won't happen until we get more inventory on the market. We're still 50% lower in inventory than we were beginning of pre-pandemic.
Well, once again, as we mentioned before, one of the most important things is with all this economic bad news coming out, it really, really turns into what we call an economic culture. Once the market takes on an opinion of a culture, things can change drastically under not even rightful information, but just consumer sentiment. Consumer feels not good about what they're doing, and consumers stop spending, keep saving money. It kind of really, really backlogs the economy, really puts the economy in a bigger tailspin than what you actually predicted.
It's funny that you mentioned that. I actually pulled up some comments that came off of a post by the National Association of Realtors, and you talk about a culture. It's not just the consumers; these are realtors that are answering this about how the housing affordability index falls as the mortgage rates climb. These are realtor answers. It's so difficult for so many trying to get a piece of the American dream. Our housing shortage plus mortgage rates increasing plus inflation equals misfortune. This other one says, holy moly. The other one says, it's so hard for first-time home buyers and it's certainly not going to get any easier. Another one, the market is certainly not very first-time home buyer friendly. Mortgage rates are up and it's going to be very hard for first-time home buyers. Another one says corporation hedge funds and et cetera have bought up more of America in single-family homes since when in history? Oh yeah, they said survival of the fittest. Everyone has a place to sleep. Who's watching this and home, and so on. So you have the National Association, and the other day there was a post where a realtor came out and said, "Why all the negativity? We're here to help people buy homes, not deter them." There is a culture that's beginning here and a mindset that maybe it's time not to buy real estate, or explain that a little bit more about how that's contagious, Gordon.
Well, the culture is, of course, is how do you see things? Are you an optimist or a pessimist? Do you see the glass as half empty or half full? Everybody, doesn't beat to the same drum. So people have different philosophies on how they intake information. Some people take information and run with it, and it can be completely false. As we've seen what's happened over the last couple of years with all the stuff that went on with the elections, those kind of things. And if you keep saying something long enough, Michael Jackson said, the lies become the truth. So a lot of times that's the negative culture that we don't want to create. We don't want to stop people from spending money. We're trying to slow the economy down, but people still have to spend because that's how the economy circulates, by spending money.
Well, I encourage everybody to do their research and get a second opinion. We consider ourselves to be the best second opinion you're going to get, maybe even the best first opinion. Do you disagree with me?
Fair enough.
We'll come back after this break. You can always reach us, Tony or Gordon, at BayAreaLoanSource.com. You can find us at Facebook. That's Bay Area Loan Source. YouTube, Bay Area Loan Source. And where else? Our website, BayAreaLoanSource.com.
Live stream.
We'll come back after this break here on AM 1220 KDOW.
Got a question? Run it past these guys.
800-516-1220.
It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us. You can always catch us at Facebook. That's Bay Area Loan Source. YouTube, Bay Area Loan Source. That's kind of developing as we go, but Facebook's pretty good. We put out posts all the time. And you can always email us, Tony or Gordon at BayAreaLoanSource.com with any of your questions. One of the questions that we ran across most recently is about bankruptcy. Now, everybody in the industry, even one of the big lenders that we called, I said, did you know you can get a loan while you're in bankruptcy? This person wants to know, they're in bankruptcy right now, Chapter 13. Can I get a loan to purchase a house? And the answer is yes. And that lender didn't even know. Most people in the industry don't know you can get a loan while you're in bankruptcy, Chapter 13, that is. It's kind of surprising that even the biggest professionals out there, the people who are representing brokers, didn't know that. So it's good to be able to tell people that there is an option if you're in bankruptcy.
Yeah, I mean, there are many different options on the marketplace right now. Of course, as the market becomes less and less flexible, I would say, we get more and more programs, which turns around and gives us more options. One of the biggest issues, of course, is bankruptcy. Nobody wants to touch a person while you're in bankruptcy. Of course, you have to get permission, I think, from the trustee in order to lend on something, or they might be able to pay off the balance of the bankruptcy, depending on what the balance is. But typically, FHA does allow for loans to be done while you are in a Chapter 13, not a Chapter 7 or Chapter 11, but actually Chapter 13, which is actually a payment plan.
And there's a couple stipulations here. You have to make at least 12 months on the plan, so it's 1 year after you go into bankruptcy. A lot of times we see people in bankruptcy, their credit score gets hurt. So you have to pay attention to your credit score. Definitely check with your, the items that were included into the payoff is the same items that are in your credit. We've seen that happen, and then somebody stops paying a credit card that wasn't included, and then their credit gets hurt. So yeah, your credit will go down when you go into bankruptcy, but it comes right back up. It's that's one of the reasons why that year period is there, so that you can reestablish that credit. You obviously have to qualify, with the income, your debt ratio, the condition of the property, and so on. But we'd like to, it's not just you have to wait 3 years on a bankruptcy or 7 years. And there's a lot of programs, not just the FHA program that allows you in Chapter 13, but there's non-QM products that will allow you to do even on investment properties with much shorter wait periods out of bankruptcy and foreclosure and things like that.
Well, credit score, of course, is a moving target. Credit scores does move in time. So a lot of times people have low credit scores. Over time, you can get the credit score up. And then conversely, if you can have a high credit score, over time, that credit score can be lowered by, i.e. late payment, i.e. not paying attention, i.e. bankruptcy, i.e. foreclosure, i.e. charge-off. So these things all affect our credit scores. We never judge you by where your credit score was. We judge you by what your credit score is. So you can't tell the lender, well, my credit score was 800 last month. This month is only 600. Unfortunately, we judge you by where you are today and not where you were last month.
The good news, and for those people who are probably millennials didn't really experience this, is that it was really, really hard to get your credit up, but it was really easy to destroy it. It went down very quickly and just took forever to go up. That's changed a lot. It goes up and down pretty much the same pace. It does take a little bit more time if you have multiple accounts that are delinquent. But yeah, they've worked that out. I was very happy to see that you can fix your credit a little bit faster, but you still have to get in front of it. A lot of people who've listened to the show for a while have heard me say this. I'm still surprised that over 50% of the people that are out there do not know what their credit score is and do not know what's on their credit at all. Especially with all of these apps that are out there, you can get a free credit report at annualcreditreport.com. You can get it through directly from the bureaus. You can get it on an app on your phone through Credit Karma, things like that. There's so many ways to get in touch with your credit and prepare. Maybe this is I'm going to sit on the fence. Rates are too high. I don't want to do this. Home price. Maybe fix your credit. Self-employed is another other people that are sitting around going, okay, we got through the pandemic. We're starting to build our income again. Our business is starting to work. Make sure you do your taxes right. If you think you're going to be sitting on the sidelines and wait for more inventory to hit the market, there are some things that you can do and work with a loan officer like us to sit down with you and look at your taxes and see this is your qualifying income. We had one client that came in and he had income all over the place, and it just didn't make any sense. And how are we supposed to qualify for them if they have a Schedule C one year that has negative income, then a Schedule C that has, I wanted to pay myself more this year. And those are the things you need to sit down in front of a qualified professional to really review.
Well, it sounds to me that what you said is preparation is the number one thing in getting your loan approved.
Well, it sounded better than just saying preparation.
Well, you and I both know that we can take a person that hasn't been prepared, get them prepared, and get their loan from decline at one institution to approve on the other, simply because of our experience and things that we know how to do. We know what not to do. We also know what to do, and that's the essentials if you're trying to sell yourself as a premier lending company, which we are. Fair enough?
That's fair. And you really are selling yourself. It's your the 3 C's, as they say, in credit. It's your capacity. It's been so long since I've used it. Capacity. Somebody will call us about it. I know it's the 3 C's, but when it comes down to it, we're still credit based and income based. Those are the 2 things that we hit all the time, and we encourage you to look at it. But it's really good news that, again, we talk about how products can drive the market, and as we see a market the way it is right now, where it feels like it's harder to get a loan because of interest rates, it's not the only reason. I mean, how many loans have we done just recently that were over 6% because they were like non-QM stuff or private money? It was investment property cash out, multi-units, apartment buildings, 5+ units. And there are a lot of people out there that just go, you know what, it's all about the cash flow, or it's about necessity. But because we have the programs to back them up, people are still able to buy houses. So contrary to these realtors that were commenting on this affordability index, okay, there's some reality to it, and you can choose to be a pessimist or an optimist. But and these people will probably answer, well, I'm neither. I'm just looking at the numbers. I'm being a realist. You still can. We don't want it to be contagious. There's still a very good market out there. Housing is in high demand still, and we're going to go over some of those numbers in the next segment. And in fact, we just hit over 400,000 for the first time as an average price here in the United States. So there's a lot of really good news still in real estate because of the desire to get it. And household formation is still on the rise. People are moving across the United States looking for larger houses. Affordable housing, yes, that's going to be an issue. But when you have builders that are basically just saying, we're going to shut down for a while, housing starts are down, that means less inventory is going to hit the market. So there's going to be even more desire for people to get into housing. And then you have the rents. I have an article right here. Rental prices hit another record high. And then they go, well, there's some good news. The year-over-year increase is going to decrease. It's still going to increase. Rents climbed 15.5% annually in May to a median of $18.49 in the nation. Rents were up 26.6% over the past 2 years. And people don't want to do that anymore. They want to buy. So Is that spreading enough good news, Gordon? Enough
Well,
optimism?
you said a mouthful, I think.
I know you were kind of staring at me for a while.
I think the market is going through a change. Now is a good time, I believe, to get good deals when the market is changing.
That is, I think, the silver lining is as more inventory hits the market, I think we're going to see more and more properties and opportunities for people in places they haven't seen before. We'll come back after this break. I'm Tony Mendez. It's Gordon Hines. This is the Real Estate Report. You can always hit us up on Facebook or YouTube, Bay Area Loan Source, or our website, bayarealoansource.com. We'll be right back after this break.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
Last segment, we were talking about some of the opportunities and the optimists out there. More than 40% of the home sellers in certain areas, like Salt Lake City, Boise, Sacramento, and other spots around the United States, are dropping their price. They are dropping their list price. Sellers are adjusting their expectations as they realize many buyers are no longer able to afford the type of home they could have before mortgage rates shot up. So if you were a buyer, Gordon, would you consider, sitting back and just kind of feeling out what the summer is going to look like? And then, we have a big buying season coming up in the fall. So it's the second largest buying season of the year. Would you get yourself prepared for something like this to buy as we see more inventory hitting these markets and then sellers starting to become a little bit more acceptable to lower offers, or at least being a little bit more real about their prices?
Yeah, if I was a buyer, I wouldn't run out and try to ink a contract today. I would just kind of wait, because I know that as rates go up, I know that something's got to give. You mentioned earlier about rents. Rents cannot continue to increase once the economics factors in. When we start getting people laid off, unemployment, those type of things, those things do affect rents. High demand, of course, everything goes up. When demand is lowered, I have seen places and times where rents have actually come down. So when we look at the overall complexity of the decisions that we have to make, I think there's a lot of information out there. We just need to kind of reach out to the professionals so we get best advice so we can make the best decision under the circumstance.
Yeah, I think rents are going to keep going up and driving people towards housing. And I think when I can share this list with you, by the way, if you haven't been able to find it, it's you can email me, Tony at bayarealoansource.com. But you look at rents, and the senior economic research analyst at Realtor.com, he says after a long period of accelerating rental price growth, we're seeing rental growth starting to taper off. He continues to say, we're hoping to see rents continue to level off. Hopefully the worst is behind us. But that doesn't, nowhere does it say that it's going to go down. It's just going to slow down the growth. So it's still going to grow. So a lot of people are still going to feel that. I mean, how many times have we had somebody call and say, I need to get pre-approved for a house. My rent just went up $1,000 a month.
Well, typically, the same as a landlord, the same as a seller looking to sell his house. He's got his house on the market. He has a specific price in mind. He doesn't get the price. What does he do? In order to move the product, he lowers the price. Same thing with landlords. You have a property on the market for a month or two, no action, you lower the rent. That's when rents come down. So level off is another fancy term for rents coming down. In a competitive market, these are the things that happens all the time. It's nothing new. So a lot of times people make predictions, but you got to make sure the predictions are relevant to the circumstance, the timing that's going on. You have to look at the whole picture, not just one segment of the picture, to come to a good consensus. To me, makes sense decision.
Do you think the higher, we're looking at 15.5% year-over-year increase on the average rents across the United States. Do you think those are justified? Let's just say that the majority of these landlords have refinanced into pretty decent rates. Now they watch rates go up. What's their justification for rents going up? Is it just because of the supply and demand, or is it because of
the cost
because they can?
No, it's not because they can. The cost, and a lot of places rents have not gone up because look, a lot of places that have the rent control. Look at Oakland, that has strict rent control. City of Berkeley, San Francisco, where if you look at the economics of it, the rent increases have been outpaced by the cost of ownership. Look at what has happened to cost of homeowners insurance. Look at what happened to cost of utilities, water, garbage. Everything has gone up. So conversely, if the landlord can't raise his rent proportionally to absorb those increases, he's actually losing money, regardless of if what his homeowner's rate has done. So a lot of times people don't look at that. We just look at, the landlord's making more money, but really conversely, he's not making more money. He's taking less money to the bank if his cost of ownership has gone up.
I continually see this harder for people to really kind of swallow what's happening with inflation when rents keep going up, gas keeps going up, the cost of housing keeps going up, and everything else in between. Where does this end? Is this going to work with slowing down inflation, what the Fed is doing, and how can this actually, what do you see coming out of this in the end? Do you see places like, we go to the top of the list, Provo, Utah, Tacoma, Denver, Salt Lake City, Sacramento, Boise, all of these places we're seeing huge drops in the amount of people who are going over asking. They're dropping their prices, in fact. Do you think those are the places that will continue to see decent growth in real estate, maybe not slow down as much as the rest of the nation, where because this is more inventory hitting the market, and you have renters that are interested in these places.
If I go back to history, those are the places that typically tumble first, because those are what we call
the ones who went up first.
The overflow markets. People were going there for one specific reason, for affordable housing. So as affordable housing, is not affordable anymore, now the area that you prefer to be in becomes affordable. You're going to stay. You're not going to move to another state. If you can buy where you are, people buy. They like to be close to family, friends.
Sure.
Business opportunities. Lifestyles. A lot of people are into these walk-in formulas that they have, where things you can walk to. Cutting your carbon footprint. A lot of people now want to ride bikes, don't want to drive cars. A lot of different things have happened. Once again, in that culture that's made the market a lot different than it was maybe 5-10 years ago.
Yeah, places like you were talking about how they were pumped up so high during the pandemic. From 2020 to May of 2022, Provo, Utah was up 65.7% on their median sales price. I think the highest on the list is Cape Coral, Florida, at 72%. But these are some outrageous numbers. Salt Lake City, 56%. Boise, 66%. That's in a 2-year period. In the median sales price change which is incredible. So naturally, we're going to see that reverse its course. But I still think that it depends on inventory. Inventory is going to be the big story, I believe, when we come up to the fall buying season. Will buyers be able to get what they can get? Will they just sit back and wait? Maybe they're waiting for rates to come back down. Don't forget, when a seller sells their house, they have to buy somewhere else. Are they willing to get rid of their interest rate to get something that's a little bit higher? So it'd be very interesting to see what happens. We're welcome any comments and questions that you have. You can shoot us an email, Tony or Gordon at BayAreaLoanSource.com. Tony or Gordon at BayAreaLoanSource.com. You can always hit us up on Facebook or YouTube. It's Bay Area Loan Source. We'll come back next week. Thanks for joining us. I'm Tony Mendez. It's Gordon Hines. It's the Real Estate Report on AM 1220 KDOW.